So disclosure, I have to do this one. This is presentations for educational purposes only and is not financial, legal, or tax advice. Past performance don't guarantee future results. And if you need financial advice, always contact a professional. Hey guys, before we go any farther, don't forget the Retirement Made Easy Living on Dividends helps support the channel. Everything goes to help support the channel, making these great videos. We have an 11 ounce and a 15 ounce mugs that you can get. We have a travel mug, which a lot of people have liked. We actually are sold out. We got more coming in now. So you can get the 11 ounce or 15 ounce. Use the QR code, use the links down below. Everything helps support the channel. So we thank you so much if you've already ordered one, and we'll thank you if you order one now. So the matchup of OVL, SPYI, and IVVW, the three ETFs provide the S&P 500 exposure and monthly income through distinct option strategies and management styles. OVL uses the overlay structure, the managed by liquid strategies, and it uses an actively managed short-term SPX put spread strategy, overlaying over the core of the VOO position. Okay, VOO is the S&P 500, SPX is the index that we look at. Now, SPYI, the NEOS package, combines the S&P 500 equity ownership, so they actually are buying an entire portfolio of S&P 500 shares, with an active SPX call writing strategy that includes long call options for upside recapturing. So right off the bat, we have, again, two different strategies, but similar. You have the put side of SPX on OVL, and you have the call option, the positive side of SPX with NEOS. And then iShares is the BlackRock's systematic approach. It owns IVV and writes monthly call options following a mechanical index-based rule set. So again, totally third way of doing this. They're doing it from their own IVV ETF and selling monthly call options off of that fund, which means you'd have to break down IVV to find out exactly where they sit. So they're both, all of them have the S&P 500 core exposure, and they're doing those monthly distributions. So the golden rule and ground rule of this, distribution rate is not guaranteed yield. Okay, I want to make sure everyone understands this. Critical distinction for retirement income. Understanding your metrics. Distribution rate reflects recent cash payout, is not a promise of future yields or SEC yields. SEC yields is standardized calculations based on the net investment income, which is your interest and your dividends. Distributions may vary from month to month based on market volatility and option pricing. So what's in the check? Well, we're going to look at single month distributions can compose of four distinct components: dividends, option income, capital gains, return of capital. Distributions are cash in hand, but they put impact on your tax basis and principal value. Return of capital estimates in a year or subject to final year-end reclassifications of what's going to happen. Okay, so we need to make sure that we understand the rules of all this. So, and I'm going to break it down now so everyone can really understand. I always called my level. That is simple. Distribution, yield numbers tell us what's going on. The yield is a mathematical number, and it can change. If the price of the shares go up, the yield goes down. And if the price of the shares go down, the yield goes up. Now, if distributions add to it, that changes things too. That's why I say it's a mathematical piece. SEC yield will tell you more about how much of the money is coming from the covered calls and the options versus getting interest across the board. Okay? So let's look at firm number one, OVL, the structure and the strategy that they use. As I said, this is managed by Liquid Strategies and invests primarily in VOO, which is the Vanguard S&P 500 ETF. The approximately 99.6% of the portfolio is into that VOO, into the large cap equities. Now, the active income overlay, actively managed short-term SPX put spread strategy. It sells put options and buys lower strike puts to collect the premium. So I'm going to stop right there and say, what is it? They're saying that today you're going to see this fund, I'm making up numbers of $50. They're saying we're going to say it's going to drop down to 49. And then they're going to buy another one, say at 47. Okay, so they're looking at the fund to go down. Now, they're not saying they're looking for dramatic drops all the way down to zero. What they're looking is for the fund, that volatility. Sure, it goes up, and then it's going to come back down, and it's going to go up and come back down, and go up and come back down. That's what they're basing off of their short-term put options across the board. They generate income from that downside insurance side of the market. Okay, as we always know, gravity tells us everything that goes up has to come down. These guys are banking on the come down side. Unlike conventional covered call ETFs, OVL does not sell away its upside. It allows the full S&P growth participation. So again, that's a huge factor to this. We see so many of these covered calls that when they do this, using my $50 number, they say at 52, we will sell you the stock. If it gets to 52, they sell it. If that thing gets to 54, they sold for 52. It capped their upside. These guys are uncapped on the upside, trying to control the downside. Now, taking a snapshot, current distribution rate, 10.46%. So monthly distributions gives you that cash flow that you're looking for. The expense ratio, 0.79, a little higher than we'll probably see. It's a little higher across the board because of what they do. And this one launched in September of 2019. So it's going to be the longest operating history among the three that we're looking at today. And tax efficiency note, the return of capital, ROC, they were 100% in July. So we have to look at the long-term side of it, but they're advertising, they're doing everything they can to give you the most positive for cash return. SPYI, the NEOS program. Now, this one we've covered many a times, and this is a very active fund in the way they designed it. The core portfolio is directly owning the S&P 500 companies to maintain the foundation and the fundamentals of the equity exposure. Now, what they do next is they do an active option overlay. And that combines the SPX call options for income with actively managed long call positions. And then they upside recapturing. They purchase out of the money calls to recover the participation in the strong markets. So I'll explain to them again on my terms. So they're sitting here saying they will own all the S&P 500. Okay, and then they're going to use... They have that. That's going to create some additional distributions. That's going to create a little bit more growth. That's going to give you a little side of it. Plus, they then are buying the S&PX call options, which they're saying that thing. They're going to say that $50 price point is going to be 52. Okay, and then they'll probably go out and they'll buy more out of the money calls to recover more participation. They may buy a 54 as insurance. So they have some growth into it, but the market has to go and the call option has to be implemented. So they create some high monthly income. The upside participation, unlike rigid buy right funds, the strategy aims to keep the door open on S&P 500 growth. And they have probably one of the best tax efficiency structures across the board. Now, when we look at their snapshot, their current distribution, 12.04. Expense ratio, 0.68. So a little bit more in line with what these normal, still on the high side. Monthly payouts, and this thing launched in August of 2022. So you got almost 4 full years now under its belt to see how well the S&P 500 from NEOS has actually done. The tax efficiency is the big selling point with these guys for sure. Not yield is a big one. Tax efficiency is another big one. They use the Section 1256 contracts because of the SPX options that qualify. They have a active tax harvesting. So if something's going negative, they can sell it off, wait the 30 plus days, and maybe jump back into it or use it accordingly. And then they also have that return of capital. They use that as well. So they're using all the tools in the toolbox to reduce your tax that you have to pay. So I always call it, it's very tax efficient. And then the fund number 3, and this is BlackRock's iShares IVVW. So this one provides the S&P exposure through the underlying holding of IVV. So this one tracks the CBOE S&P 500 enhanced 1% out of the money buy right index. It's a lot of mouthful there. Most mechanical buy right approach among the 3 funds. It's a systematic, rules-based execution for transparency and consistency. Okay? So what they're doing is they're selling call options, write options off of their own IVV ETF. So it owns the full S&P 500 exposure with the IVV shares, and it writes and sells monthly call options against the position. Now, I'm not saying this, but this is where someone like Neos could be buying theirs as the future call options. That's why the buy right is designed that way. They collect premiums to generate that consistent monthly income. Now, it's not guaranteed. I always got to say that. It's never guaranteed. But the fundamental trade, the call premiums provide reliable income, but strong upside moves in the S&P 500 can partially sacrifice due to the short call obligations. So what they're saying here, they're going to generate income from the calls, but they're going to cap it, and you're going to miss out on the growth of the fund. Now, IVVW snapshot here is they have the lowest cost, and I'll tell you that right up front. They have the lowest cost winner in the expense ratio of 0.25%. So that means you're only paying $25 for $10,000 invested of holding price. Now, the current analyzed rate is 11.34%. Now, here's the big ticker, though. This is what's going to change everything and kind of stop me a little bit saying, whoa, hold on here. We're probably got to be careful with this. But September 17th of 2026, they're changing the entire strategy of their program. And when I say entire strategy, these guys are set up on a monthly strata basis. So they're going to change the name from iShares IVV Premium Income ETF. BlackRock announced the change to the fund's principal investment strategy. Instead of doing monthly, they're going to do weekly strategy changes. Okay, and when I say strategy changes, instead of selling one a month, a call option put out there for a month, they're now going to do it for 1 week. So they're going to do 4 a month versus 1. So that's going to give them more options to follow the market trend. And this is what we're seeing a lot of, that companies changing the system, because these things are getting so big and so powerful that they need to start changing the systems around. And when they change the systems around, and it comes into is now they're able to adjust to the marketplaces. So I think this is going to enhance the program more, but we're going to have to wait and see exactly the big changes to it. So I'm almost like putting this to, I won't say a total reset as a startup, but I will say it's an option. You got to watch what you're going on with this fund. If you own this, I'd love to hear you. If you know about this change coming up, it is a fairly big change in an ETF fund. So let's do the head-to-head comparisons right now. In round 1, we're going to talk about income. This is what a lot of people look at. This is what I call yield, and this is a lot of people chase yield, and they'll say, "Oh, SPYI wins, so we're done. I'll invest in this money." SPYI does a great job. Neos has done good because they're built for income-focused potential at 12.04%. Now, IVVW, even with that monthly thing, is coming well at 11.34%. So you got to be careful with that. And if the changes coming in, could that boost them up to above the SPYI point? Well, we're going to get this on our watch list. I personally do not own it. I do own the other two, SPYI and OVL. I do own those. I do not own the BlackRock iShares, but it will go on my market to say, hey, we're going to watch this because they're only 0.75 of a percentage point away from SPYI. And I think if they do the weekly thing, they could bump this thing up to even higher numbers yet. Number 2, the growth potential. OVL with that put spread has really number one with the pick, that they have the option, they have the strategy that seems to be working currently, definitely in this year. It maintains that near full S&P 500 exposure through the VOO core. Now it doesn't sell calls, it avoids the upside capping, it sells those puts that's doing it properly. Number two is going to be SPYI, and number three will be IVVW. And then this is where I really just relate it right to, is going immediately to total return. When we take a look at total returns, you're looking at 26.11%. Okay. Year to date, they're up 12.07% for the, again, total return. Now I'm showing you here what you can do is you can just take away the yield that they've done and see how much growth they've had. So as a whole, in total return, OVL is winning because they have a better, stronger growth package and giving you about a 10% yield. Okay, so you're getting the growth and you're getting some decent yield. Now we go to SPYI, 19% in 1 year return. But remember, we're at 12%, so you're really only about a 7% growth. Big difference between the two. 10% income, 12%. 16% growth, 7%. So you can see how these two really work, almost I want to say opposite of each other. One's designed for income, one's got the big growth package. Now IVVW, this is where it really comes in the challenge. They're just a little bit off in the growth. They're down to about 6% with that 11% income. So I put them as a distant third, but you can see just by the year-to-date numbers even that it's in the same order, 1, 2, and 3. So LVL versus the S&P 500. This is an interesting one that came across when I did my research. As of, the total return of 1 year, as of July 31st, I sat down and did this and found out OVL has actually beat the S&P 500 index. So what they're doing is working and working well. And this is probably why a lot of people on the channel always come back to me and say, Doug, you're missing it. OVL. You need to be OVL, OVL. And I'm starting to learn more and more as we go through this, how that structure that they do has changed the world. So OVL demonstrates the power of its put spread overlay, capturing the full equity upside while the S&P total return index is trailing behind it. So their indexes are behind by about 3 percentage points. So even though we're talking about a 10% yield, which is still a strong number to work with, we're also picking up additional growth that we're not, it's almost like we're getting all of the S&P 500 growth, plus we're gaining on the income. So this was an interesting piece I wanted to share with everybody. So round 4, tax efficiency. Guys, every time you talk taxes, NEOS is the answer to it. They rank number 1. They are number 1 again because they use the multiple faceted pieces, the Section 1256. They use the tax harvesting. They use ROC. They use every tool in the toolbox. Now, OVL, the ROC that they use is definitely reducing that. And IVW doesn't have as good of a system. They use the 1256 contracts. They do use a little bit of ROC. But here's what I start looking at people and saying, if your pre-tax is 19% from SPYI, you're basically looking at about a 16% return. Now, OVL, people will argue with me again. This is simulated. I just got to tell you guys, this is all simulated. And I went back to 2024 to give you guys a real good answer. Their total pre-tax was 27.66%, while their after-tax was 27.16%. So they only lost about a half a percentage point. I just did not have all of the hardcore records from 2025 because technically I didn't own it back then. So I lost that information, or I would have made it 2025. But right now, they're focusing on 100% return of capital. That could make some big differences down the road as well. So the fluid nature of tax estimates, this is the thing, and I'm going to put this whole screen in a very, very short answer for you. ROC the classifications can be very good things and very promising things, but until you get your 1099 DIV, it means nothing. I don't want to ruin anyone's day, but the answer is you can get someone saying we're giving 100% ROC, and you think this is great. It's great distributions, great income. I don't have to pay my taxes until way down the road. I hate to tell you, until the end of the year when you get that DIV is when you really have to worry about it. And that's what falls into play. So cost analysis. I told you this ahead of time. IVVW wins it hands down. It is unbelievably cheap. So if they get their performance, I already like their income side of it. I don't like their total return side of it. But across the board, I think if they get couple things dialed in, they could easily walk into being one of the major players in the S&P 500 category. So the final score and summary, you look at the chart, and when I first looked at that, I said, boy, what in the world did we design? And I started thinking about saying, this is it. This is the box. This is what we play in. This is how things go. And SPYI is going to dominate for the most income winner. OVL is going to give you the best total return and growth as a total package with some income. I always call it maybe more of a balanced approach across the board. Tax efficiency is definitely SPYI, and the lowest cost, if that really bothers you, is IVVW. So determining the best income and the best for your income bucket fit, well, it gets very, very difficult across the board. And I think, Bo, is the best overall balanced approach. OVL gives you some growth, gives you the total return, and gives you that yield that you're needing. Excuse me, for 2% more, SPYI gives you bigger income, lower growth, but a heavy tax efficiency if you're in a brokerage fund. So overall, the case study that I did here says everything is OVL wins the game. SPYI is only if you want the highest monthly cash flow with some tax efficiency, and then IVVW is if you want the lowest cost. Still giving you a nice 11% yield off of it, but overall, it's how the three works. Now, what I like to do, and I've been a firm believer of this, and it goes this way. I like blending the funds together. Okay? I personally have always been SPYI first, OVL came into me second. The more and more research I do, the deeper we find into it, I've actually now flipped a lot of this in a lot of portfolios to OVL first and SPYI second when someone is asking that they need some new growth, they need some new income, they want their portfolio to get bigger, but they need the income still to live off of. So I've switched it to 60-40, which has always been my number, 60% in the core, 40% in the satellite, and I'm thinking right now, the better option for us is OVL and SPYI because what it gives us is 11.1%. So we're really only giving up less than basically I'll say 1% of having SPYI first, okay? But overall, I think that's just better package of getting you new growth, using them as a satellite core package. So my final ranking, as I said, OVL overall, if you just want to pick one, OVL is the way to go. It has the income, it has the growth, it has the total returns. SPYI NEOS definitely has the higher income across the board. IVV is the lowest cost. But with that, subject to announcing those changes in September, I think it's one that's on the back burner saying, let's keep a close eye on this particular fund. Let me know your thoughts. If you think this is the right way to put it, let me know if you like the blend side of it. Are you a blender like I am, or are you just a one and done type application? So a retirement formula is income, growth, NAV protection, taxes, total return across the board. Guys, I want to thank you for watching. Let me know your thoughts on all of this stuff, because without you, we couldn't do this channel. So let me know which fund fits your income bucket the most, OVL, SPYI, IVVW. If you own IVVW, I'd love to hear from you guys. But just point blank, I like blending the two. I think IVV could actually be a blender, But I think, as you saw, the must way of doing it is OVL and an SPYI. Let me know your comments. Love to hear from you. We'll catch you on the next video.